So as we've had this talk of recession dwindling, what does that mean for the state of the economy? Are they right? Jennifer Lee Bimo, senior economist, is with us now. Josh brought up a really interesting point here that we have definitely seen corporate earnings calls that the discussion of recession has come down. I would say sort of anecdotally on people that we talked to on the show. It's not quite as clear as it was a few months ago. Where's your thinking stand on if and when we're going to go into recession?
Well, good morning. Thanks for having me on the show. Just listen to Josh. It just shows how markets and economists, analysts, we've been all over the map. We have, but you know what? We are still calling for that recession. I mean, things have slowed, obviously, right? We've had 500 basis points of Fed rate hikes. It's having an impact. Maybe it's not having the big oomph that normally it would have, but things have started to slow. Just look at the retail sales number last week. I was actually at a conference, and somebody had texted me the numbers right away. And I saw the headline and the core number. I thought, oh, great, are we going to start pushing off this recession start again? But but when we look at the details within the retail sales report, it wasn't exactly all positive. There were still quite a few sectors that were down. It'd be like half and half. So things are slowing. Things aren't slowing dramatically, but things are clearly slowing, especially in the factory side. So we are still looking for that negative quarter for Q2 to kick in for Q2 and Q3. But we've always been saying mild contraction, and we are still sticking by that call.
So you are calling for a recession then later this year and not in 2024 still?
Correct.
Okay. And then one follow-up question I have for you, because since I know you heard our conversation with Josh, what's your expectation for the June Fed meeting? Are you expecting a pause? I can't see a rate hike happening, but what are you expecting?
Totally on side with that. No, we are not looking for a rate hike. Our call has been that last meeting was the final rate hike, and then they would stay at these elevated levels for some time, and probably until 2024, and then the first Fed rate cut to kick in 2024. If there is a risk, and there's always a risk on either side, it will be to raise rates. And right now, I mean, the data are not pushing for a rate. I don't think it was pushing for a rate hike per se, but if things continue to remain strong, they're going to be watching things like further job gains, continue to watch consumer spending. I'm dying to see what's going to happen at this Friday's April PCE report. And of course, inflation. And if it continues to stay strong, then we could see another rate hike coming down the road, but I don't think it's going to be in June. But again, base case scenario, that's it until 2024, and then we start seeing rate cuts. And of course, it depends on how all these talks play out. And, if we do see things fall apart, which again is 50-50, and I have no idea how this is going to play out, that, we could see it's almost a reason for the Fed to actually stay on the sidelines, for at least for now.
Oh, goodness. I hope by the time the Fed meets, we know what's going to happen with the debt ceiling. But, who knows? But I am curious your thoughts on that. I mean, as you said, it's 50-50. It's even tougher to game that out than it is maybe than the overall economic direction, right? But it does feel like the consensus is pointing to a deal, even if it's not exactly by the X date soon thereafter. Are you guys in that camp also?
We are in that camp. I mean, quite frankly, it's a lot of political theater. Yes. In my humble opinion. But I think that at the end of the day, cooler heads will hopefully prevail. If we start seeing markets reacting very badly, in the event that it looks like it's not going to go anywhere, we might go a little bit past that X date if it is indeed June 1st, and then we could probably see hopefully a deal soon after that. And so hopefully it'll be very temporary, I think you said earlier as well. So we'll see how that plays out, but it obviously will be, to borrow, I forgot whose word it was, but it was, it'd be catastrophic if they did not, if this thing extended for a while longer.
Yeah, they've certainly kicked the can down the road in the past. I mean, we've been through this before, to your point, 2011, 2013. I mean, time upon time again. And, some voices say we should just do away with the debt limit. That's a separate conversation altogether. I want to ask you really quickly also about the job market. That's one of the things, one of the areas of the economy where there has been continued strength and unexpected strength, and particularly like in the last report. Are you expecting to continue to see that strength when we have the next report coming up in just weeks or less than a week now? Or about a week.
Next Friday. We're still looking for something, on further job gains, maybe a little bit of an uptick in the jobless rate. But it's still going to be ongoing jobs. We're not going to see obviously 500,000 jobs again, but something around the 200 level or so would be considered a decent gain. And of course, whatever the breakdown is going to be, and then of course what happens to earnings. But all of this has been like the overriding feature, I think, for this entire situation is that, and the reason why we continue to call for a mild recession is because the job gains remain strong. There's still talk about hoarding. People or businesses are reluctant to let go of a lot of their workers because they know how hard it is to hire them back. And of course, wages are still rising, or maybe at a slower pace, but still rising, and that's helping consumer spending, and that's what's going to cushion this entire recession.
And finally, I want to widen out and look globally for just a second here, because we earlier were talking about a potential COVID surge in China, and even there, growth is not what it was, right? And if you look around the globe, maybe other areas have been a little bit more resilient. But as it pertains to U.S. growth, what's the sort of dependence on the global economy at this point? And is that going to be a curb on U.S. growth or help it at this point?
Having other economies continuing to grow, Europe has been beating expectations. The UK as well, managing to circumvent a recession, which is positive news. Doesn't mean that everyone is out of the woods just yet, because it's the year is still young, inflation is still, especially in the UK, it's still very, very high. So that is going to weigh, I think, overall on broader global growth. China, had a big strong start to the year thanks to very weak year-ago levels. But we still see China, meeting their growth target of about 5.5%. So that would overall help the global growth, and of course help the U.S. as well. But the U.S. is obviously going to be the big driving force, and we need to make sure the U.S. continues to move in that direction before we start talking about things like a global recession.
Right. Jennifer, always good to catch up with you. Jennifer Lee, BMO Senior Economist. Thank you.